What's up everyone, it's Karthik with MoneyVest. So we got brand new breaking news that came out about 6 to 7 hours ago as Joe Biden has officially dropped out of the presidential election race, and how the markets are reacting as both the S&P 500 and the NASDAQ futures are somewhat green, modestly higher here on Sunday night after this breaking news that came out. And there is certainty and uncertainty at the same time in the markets right now, and I'll go over exactly what to expect and how the markets may react in the coming weeks leading up to the election, which is just over 3 months away. As always, if you enjoyed this video, find it helpful, make sure that you drop a like and subscribe to the channel. I would really appreciate that, and links to our Discord and Patreon is going to be down below. We added a brand new feature for all of you on our MoneyVest platform. So again, this is the entire platform which you can access with a 51% discount. And now we've also got the earnings calendar, so you can come over here, take a look at all the upcoming earnings as well as the revenue and EPS estimate available for each and every stock. So for example, Google is reporting this upcoming week. We got Tesla, we've got Enphase over here. So all the earnings are going to be scheduled in a nice weekly format. You can also look at the previous week. So if you come over to the previous week, they're all going to be color coded by red and green, showing you whether the companies are beating or missing expectations. Again, you can take a look at all the earnings broken down by every single day and all the upcoming earnings as well for different weeks of different months. So links going to be down below. We'd love to have you on board. If you have any questions, please feel free to reach out. So first things first, let's talk a little bit about the official announcement. So investors react to Biden pulling out of the presidential race. He essentially informed everybody on Twitter. So on X, he put down a one-page notice or memo, essentially letting the world know that he is going to be dropping off the race for the president, and he is also endorsing Kamala Harris for the nomination in terms of the president of the United States. Now, there is certainty and uncertainty at the same time. Why do I say that? And the reason being is because, of course, this tilts the odd very much in favor of Trump for November, and that is exactly why the markets are a bit more certain about who is going to win. But at the same time, there's uncertainty regarding who is going to be the nomination from the Democratic Party. That's the uncertainty. The certainty is with regards to who potentially could win in November, but the uncertainty is who's going to be running for president from Democratic Party. And the markets hate uncertainty. The reason why we're pushing higher pre-market, as you can see, the NASDAQ futures are up a little bit over 33 basis points. As of the time of this video, S&P futures slightly modestly up over 19-20 basis points, is because of the lack of uncertainty that we just witnessed on Sunday after the announcement from Joe Biden. So moving forward, you'll notice that this is actually happening for the first time since it could happen for the first time since 1984. I got to take my words back because we're not done with the election yet, because a lot of people are already sounding the alarm for victory for Trump. But of course, we have to be aware that the presidential election is not at least 3 months out, right? So a little bit more than 3 months out. But this right here is the research that shows how the stock market performance leading up to an election has been a major indicator of the outcome. So what this basically means is the performance of the S&P 500 in the 3 months before votes are cast has predicted 87% of elections since 1928. So that is a very, very high number. And believe it or not, 100% of the outcomes are predicted by the S&P 500 since 1984. So if you go back 40 years, worth of elections, that's 10 elections that the S&P 500 has predicted. It's been on point. It's been on point over the last 40 years since 1984 in predicting the outcome of the presidential election. So in other words, when returns were positive, as they are right now for the S&P 500, the incumbent party wins. So is this going to be the first time ever in 40 years that we're going to see the returns be positive and the incumbent party lose? That's the question. Is this time different? Because as you can see, that as the S&P 500 3 months prior to the election day is up, right, by on average 4 to 5%, the incumbent party has won. And then of course, 1 month prior, it's still positive, incumbent party wins. 1 day after the S&P 500 is lower, in terms of, if the 1 day after it's lower, it's negative, then it's kind of the same for incumbent party winning or losing. It's the same for 1 week after and 1 month after. But of course, it's really the prior to the election day is what we're going to be focusing on. And again, 6 month prior, 3 month prior, 1 month prior, the S&P 500 being positive has predicted the outcome of the election with incumbent party winning the election. But the question again remains, is this time going to be any different? Now, this is also stock market and bond market performance during an election year, so it should be of no surprise that the markets perform better during a year when the incumbent president is elected compared to a new administration. As explained earlier, the markets hate uncertainty. As I also mentioned, the markets do not like uncertainty. What they're looking for is some certainty into the future and again, make decisions based on that certainty. A new president can create more unknowns, the potential for increased regulations, higher taxes, and other shifts the markets perceives as anti-business can all influence a sentiment. Now, this is a unique situation because we already know that Trump was in office 4 years ago, and a lot of the policies we're already aware with regards to corporate tax rates, immigration laws, education, healthcare, all those different things. We are already aware of what he's proposing. So again, the lack of uncertainty is where the focus needs to be for the market, because if there's not a lot of uncertainty, the markets are going to be bullish and they're going to be more optimistic about the next 4 years or the future. Because in general, as you'll notice, regardless of who's in office, markets have done really well, except for a few presidents in the past, Nixon, Ford, that have not really been able to see the markets rally during their time in office. But in general speaking, markets have done really well over the last, of course, 100 years, as they have continued to push higher regardless of who was in office. So in other words, once the uncertainty is removed, and regardless of what happens on election day, the markets in general, in my opinion, are poised for very nice gains over the long term. But of course, that's still going to come at the expense of some significant short-term volatility, as there continues to be this open-ended election with Democratic Party still not with an official runner for the presidential candidate, and of course Trump. The odds and the bets also tilting more towards Trump's favor as after this huge announcement from Joe Biden. So buckle up, prepare for increased volatility. And historically, the volatility in the stock market is elevated in the months leading up to an election. This is logical as the markets hate uncertainty. Again, a couple times they've mentioned this. For investors, it's important to step back, put personal feelings about politics aside. And I really want to emphasize on this point that this is not a political video. This is not me sharing my political views. And I really don't want to dive into the politics of the United States, but really just help you understand how the markets could react. So in other words, there can be significant volatility leading up to elections, especially in the next couple weeks as we figure out, and there's going to be a lot of cooks in the kitchen when it comes to the Democratic Party and the candidate running for president. But as soon as that uncertainty is removed, right, whether it is pre-election, post-election, as soon as that uncertainty is removed, then you better be in the market, because that's going to be the time when the markets are going to see a little bit of a recovery, as we have seen a lot of potential pullbacks here in the last 3 to 4 days, especially in the last week here, as the markets were selling off. S&P was down 1.5%, NASDAQ was down over 3% last week. So we continue to see a bit of a pullback on the back of some profit taking and some uncertainty related to what is going to happen during election day. Now, beware of bold predictions. So recall the 2016 election, and this was the time when the markets recovered over 6% intraday, as before the election, the futures were down over 5% in pre-market trading. And after the elections of 2016, when we essentially had confirmed that Trump was going to come out ahead, the markets have recovered all the way up those 5% pre-market loss, and also up 1% on the day. So there's definitely going to be significant amounts of volatility in the markets moving forward. Now, coming back over to the S&P, the NASDAQ, and of course the volatility as well. VIX was up over 32% last week. So this is going to be our key indicator, as well as the MoneyVest Index, as our guide to better understand how well positioned we are in the markets in terms of that risk reward. I'm going to start deploying cash into the market. My cash exposure has increased since last week because I had sold Tesla calls that expired in the money. So I have been able to get my shares called away. Some of my shares, of course, a little bit of my position has been de-risked at a nice profit. And I've got some cash available that I'm going to be selling more puts so that I can take advantage of this market sell-off, and of course take advantage of some nice cash flows and some premiums. So volatility, next level is going to be inside this sort of green area. It's going to be between 19 to 21, all the way up to as much as 28, 34 to 35. As soon as we get to those levels, I will be deploying some heavy cash into the market as the MoneyVest Index continues to also come down closer to 3, down to as low as 2.4, 2.5. It's going to represent some pretty nice risk-reward ratios and a more favorable environment for us to dollar cost average into the market. Same thing is true for the S&P 500 and the NASDAQ as well. So this right here is the SPX. You can see a bit of a pullback here last week at almost 2%, and the next support really is going to be down as low as 5250. And if you do take down this low, which is the previous low for the S&P 500, overall you can see that it's still very much within the context of a nice uptrend. This right here, higher highs and higher lows. Of course, this was the lower highs and lower lows back in 2022 during the bear market. And again, this is the overall uptrend, which we are still within the context of an uptrend, and we are still in a quote unquote dip. We're not in a bear market. We're not in a correction. We're not in a pullback. We're only within a dip right now. But 5250 is going to be that first support all the way down to as low as 4950. So under 5,000 is going to put us into a correction for the S&P 500. We're going to be down over 12.7%. At that point, of course, there's going to be some heavy dollar cost averaging opportunities for the market. And NASDAQ, of course, also in a very similar situation where it continues to roll over a little bit. So we're seeing this right here being the higher low. You could also argue that this is another higher low over here for the NASDAQ, and this is going to be the higher high for the index as well. So as we continue to trade within this uptrend, next support really is going to be down to as low as 16,005, aligned with that previous resistance, as well as this higher low that's going to be sitting roughly at around 15,250. Very important levels to keep in mind. And of course, the lower we get, the better it's going to be for us who want to dollar cost average more aggressively, who want to take advantage of these opportunities and start buying and start investing more aggressively again. Again, take this as an opportunity, because every dip, every pullback correction is an opportunity to buy, to invest. It's a buying window that's kind of opening up. And as we know that over the long term, the markets are, potentially going to do well as earnings and spending and investments in AI and technology continues to increase. One more thing I want to mention is that it is possible that whoever comes into office next is going to be handed over an economy which is heating up to its brink here, because of the fact that a lot of the spending is fueled by debt. As we know, credit card debt, mortgage debt, auto loans are at an all-time high in the trillions of dollars, and the yield curve has been inverted for a very long time. And as it starts to invert, or that unwinding process begins, unemployment's also on the verge of maybe potentially pushing higher, because if you come over to UN rate, that's the unemployment rate, you'll notice that we're already starting to see a bit of an increase to 4.1%. So this number has increased from 3.4 to 4.1. So we're already starting to see a bit of a 21% increase in the unemployment rate, which again has happened in the past as interest rates were higher. So if I bring up the interest rates over here, Fed funds rate on a new price scale, you'll notice that every time we have seen interest rates go up, eventually it's led to unemployment pushing higher, because it takes time for the interest rates to take into effect. And again, you can see interest rates being higher here, unemployment eventually skyrocketed, interest rates being higher here, unemployment eventually skyrocketed, interest rates being higher here, unemployment eventually skyrocketed, interest rates being higher here. Of course, unemployment skyrocketed. This was also part of COVID. But again, interest rates are higher here. So I wouldn't be surprised if unemployment actually does increase from this level. So it's possible that whoever comes into office in November is going to be heading over an economy that is potentially on its way to heading into a recession. We'll find out very, very soon, but it's going to be a bit of a tough job for whoever is going to be in office starting November. But that being said, it still does not change the fact that it's going to create opportunities for us. There's going to be a lot of reasons to not invest. There's going to be a lot of reasons to always be worried about the markets or the economy and stressed about the economy and the markets. But bottom line is, it's really important to take them as buying opportunities, because if your time horizon is anything over 5 years, over the long term, the markets have proven to do really well over longer time frames. In fact, it is theoretically impossible, and I'm talking over 99% probability, for one to lose money if you're investing for over 15 years in the S&P 500. That is statistics right there for you. So hope you all enjoyed this video, found it helpful. Make sure that you drop a like and of course subscribe to the channel. Again, check out the links going to be down below if you want to join, be a part of our MoneyVest platform and our community, get access to all the trade alerts and the ideas. Again, we've added this brand new feature which is super cool, just earnings calendar with the earnings estimates, revenue estimates available for you, broken down by several weeks out, and that's going to be available for all the members. 51% discount available until the end of this month. As always, happy investing. I'll see you all in the next video.